Welcome back to FT On Air from the Financial Times in London, and a very happy new year from us to you. It's been a very good start to the year weather-wise, as you can see from our nice studio here on the Thames. It's also been a good year, a good start of the year for the British economy, with positive data, strong growth coming through from both manufacturing and services surveys this week. This wasn't supposed to happen. A lot of us, very much including myself, expected pretty quick downturn after the Brexit vote back in June. And so we have some explanation to do. And in order to help me with that explanation, I'm joined by Giles, our economics editor. Chris, the pessimists were wrong, weren't they? I certainly expected a worse result, a worse economic effect of the vote to leave the EU back in June. I won't put words in your mouth, so I'm not going to say anything about what you predicted. But why don't you tell us your take on why the economy has, on the whole, defied the pessimists?
Well, I think it's not just defied the pessimists, it's defied the optimists as well. In fact, almost everyone agreed that if the UK voted to leave the EU, the initial months, year or so would be rather difficult. If you look at the economists for Brexit, so these are the economists who actually supported Brexit, it was very much a long term.
It would be good for the economy.
Said it would be good for the economy in the long term. They also said that there would be some disruption in the short term. So this has confounded everyone, certainly including myself in this. So I think it's really important to look at what's happened. What has happened that no one thought would happen, and it's all in the consumer sector. So it is the consumers are spending far more than anyone thought was likely, and it's not because their incomes have risen. It's because they have defied. They've basically said, been very pleased and happy since the Brexit vote. There's no regret yet, and they've spent more than their spending has gone up more than their incomes in the last.
So they're saving less.
They're saving less. They're
or
borrowing
more.
So we've seen some consumer credit data out this week showing the highest consumer credit growth since 2005. So that was at the peak. So it's higher than right at the top of the bubble, but really, really high, over 10% consumer credit growth. Most of that is not on credit cards, but it's mostly motor vehicle purchases on credit. So we're seeing people rushing out, borrowing, buying cars, buying other consumer durables. This might be rational. This might be an entirely rational response, knowing that in 2017 prices are going to go up. We've seen a 15% fall in sterling, and maybe economists just didn't realise how rational the public were, going out, buying things early, and then things might turn out to be much worse in 2017. That's one possibility. But there's lots of other possibilities. Maybe people were deceived by the sort of the Brexit rhetoric. We were told we'd have our cake and eat it. We'd be better off if we voted to leave the EU. Maybe people believed all that, even though economists were saying most of this stuff wasn't actually true, and so have spent accordingly. Or maybe actually people really think and genuinely think, and maybe you're right, that the long term is good, and so they've been bringing spending forward because Britain's going to be a better place having left the EU. These are all very rational reasons for why spending might have gone up, and maybe we should have thought a bit harder about this before the vote, that these, if there was a vote for Brexit, then people wouldn't be upset necessarily about it. That confidence wouldn't necessarily fall because the majority had actually voted for what they got. I mean, you have some other sort of maybe less rational views of why this might happen.
Well, I was suggesting, because these three options you just gave, all of you can read this in more detail in Chris's column from this morning. I added in a tweet to that column that, well, it could also be that not just are consumers thinking ahead and being optimistic and therefore spending. It could be that they're looking back, and we've had 1-2 years of real wage growth in the UK after 5 years pretty much of wage contraction, actually. One of the worst outcomes in Europe. Only Greece had a bigger fall in wages than the UK. Finally, wages were growing again, so it's natural that people start loosening the purse strings a bit. And if they expect that to continue, because not rationally, but you might just think that what happened last year will happen again next year, then it's completely rational to save less because you think you'll have more to spend, more income.
But again, I think we can say that I'm sure we can say that none of us were predicting this. We're all in all of these things. We're rationalising something we didn't expect, and that is everyone didn't expect it, because what people expected after the Brexit vote and before, in the event of a Brexit vote, was uncertainty. We've got that, certainly, in terms of the policy sphere. And then that uncertainty would make people think, this isn't actually the right time to be making big decisions. And that seemed to be, in the first few weeks after the Brexit vote, the way the public were responding. But very quickly that dissipated.
This is important, actually, because all the July surveys showed huge contractions in all sectors, all areas of the economy: construction, manufacturing, services. Everyone was scaling back. Yeah. And then very quickly that rebounded. And what we saw, just to go through the facts, the third quarter real growth data, the economy sort of hummed along at about the same rate as before, 0.5, sort of 2% a year, a bit less.
Very much in services, though. Manufacturing and construction were down, and agriculture. Well, agriculture is very tiny, but manufacturing, construction and agriculture were all down in the third quarter. So it was a very much services driven. And in the services, the retail sector was by far the best performing sector. So it is very much a consumer story, this.
So, if you have to hazard a guess about this year, 2017, how do you see the UK economy?
Well, if I had to hazard a guess, I would still stick pretty much to the sort of forecast I had before, which is that as things become more concrete, I think companies will be relatively cautious. Not that they're necessarily going to be cutting back hugely, and that household will become more cautious as the year goes on, and as they realise that they've had 2 years of pretty good real income growth, and that's not continuing. Particularly poorer households where benefits and in-work benefits, so tax credits and things, are not going up at all. They're going to be frozen. So the effect of that is greater the higher inflation is.
And in fact, there is something going on here that's completely separate from Brexit, which is that 1 or 2 years of real wage growth is very likely over, partly because of budgetary considerations. There'll be further squeezes on the government budget. Of course, a lower pound, higher inflation, as you mentioned, that will be felt in people's pockets. So completely apart from the Brexit negotiations, there are some good economic reasons to think that actually this consumer boom certainly can't last forever, and it might actually be running out of steam as we speak.
And that's what's really driving the economic forecasts of a slowdown. It is really just that real income growth is expected to be pretty much zero in 2017, early 2018, and a little bit of business investment, offset a bit by a bit of better performance on the trade side. It's that's really driving the lower forecasts for economic growth in this year, not that people are suddenly going to look at the Brexit vote and go, oh, this is something, that is not in the economic forecast at all. So that is entirely sort of outside where the forecasts are at the moment.